Hello everyone, hi, welcome to the channel of Wall Street Mojo.
Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon.
Today we have a topic with us is called interest income. What this topic is all about. See, just like there is interest expenses in the profit and loss statements, there are interest income. We will try and evaluate this in a very detailed format. Have a look over here, the extract that is taken from the profit and loss account. There's a total net revenues, data, cost of sales is deducted, stores, operating expenses, all rest of the expenses are there. And then there comes the interest income and other net and interest expense. Let's try and evaluate this. First, what is the interest income? See, interest income is basically the amount which is, allocated as interest received by the company's investment. So it actually is the revenue that is earned from lending money. So it is the term which is used by the companies on their income statement to report the interest on the cash that is held in the saving account, certificates or deposits or other sort of investments. These interests was not a part of original investment. It is separately recorded, and the interest income is obtained by multiplying the what we call as the principal amount by the interest rate or the time period, the money. These amount can be compared to the investment balance for estimating the return on the investment that business is generating. So these revenue is taxable and is recorded in the income section of the income statement. Now we can conclude that the excess revenue which is generated from the interest earned on the asset is the income from the interest, right? Now we will try and take an example here to understand the whole thing. See, there is net interest income. So let's take an interest income example of Bank of America. Banks are the best example for this. See, revenue for the bank is different from the revenue of the non-financial company. Revenue for a bank is comprised of net interest income and the net non-interest income. So for Bank of America, the total interest earned for the period was $57.5 billion, and the net interest income, that is the total interest minus the total expense, was $44.6 billion. Third, we'll discuss the types of the interest income. See, there are two types of interest income. The one is called the income from operations. See, in case where company's income statement shows that income from operations and other income separately, and sort of other income, if they show both of this thing separately, then the types of the interest income depends upon the primary operations of the business. Now, if the business is primarily making income from the investment, business is primarily making income from the interest, like for lending companies and financial institutions, then this is taken as income from operation. So we note that Bank of America's core income is only from interest. It's core income. The second is the non-operating income, or it is also known as the other income. See, if the core income does not come from the interest, then it is non-operating interest income and comes under the other income. Now, all individuals as well as the organization, they have these called financial assets from which they earn the variety of interest. And the interest which is earned on these investments over a period of time is taken as income for the organization. So in most of the cases, the interest which is earned by the individuals or the organization is reported in the income statement. either under the income from operations, or as the other income. So the internal revenue system, that is the IRS, has made it mandatory that the interest must be reported as the taxable income. Now, we will try and incorporate the accounting part also here. We'll try and learn the accounting aspect. See, with reference to the accrual method of accounting, the interest is recorded as it is earned and not necessarily as it is paid, by making the assumption that the risk of receiving payment is low. Cannot be possible. So to keep it a proper record of accounting for interest, a detailed understanding of the investment terms and conditions is required. So the calculation of these accrued interest is dependent on the interest rate, compounding period, and the investment balances is taken into consideration. So these are the amounts that can be either be paid in cash, or it can be accrued as being earned but not yet paid. So in the later circumstances, this can only be reported if there is probability of receiving the cash and the amount of payment which is to be received, and that can be ascertained. So it is obtained from the investment or the investments of the entity that pay interests, such as the saving account or any CD, that is the certificate of deposits. So it should not be confused or mixed up with the dividend, as both are different, and the dividend is paid to the holders of the company common or maybe preferred stock, and it signifies the distribution of the issuing company's retained earnings. The penalties paid by the customers on the overdue accounts receivable are also treated as the income, because these payments are related to use of the company's funds, like account receivables by the customer. And there are some companies who prefer to mention the type of the income as penalty income. So this is reported within the interest income account in the general ledger, and it is a line item. It is the line item and is generally recorded separately from the interest expense in the income statement. So these income is taxable as per IRS, and the ordinary tax rate is applicable to the income. Now, the types of the asset which help in earning interest for the banks are varied, like mortgage, auto loans, personal loans, and commercial real estate loans. How does interest income actually works, for the individual and banks? See, let's say suppose a person runs a big size capital goods business, and he has a balance of, let's say, 10,50,000. That is 1 million. The company's saving account. Now it must be understood that this 10,50,000, that is 1 million, 1.1 million plus, is not going to be lying idle in the account until the owner decides to withdraw the amount. So the bank in which the saving account is maintained, they loan this money to other people, and in return they get interest on the loan amount. And this system is also known as the fractional banking. Now the bank in this situation keeps a small percentage of the actual amount of 10,50,000 deposit in its hand. So now these loans are given by the bank and can be for the long term or short term. The short term loans are the overnight loans. They are given for the overnight period, and they are getting the money of the person's deposit in the bank, and then they pay an amount of the interest to the owners of the deposit, so that the owner is motivated to keep the money in the account. So for the entire year, the cash balance is the earning interest paid by the bank at the end of each month. So the bank is required to send out the details giving out how much interest it has paid to the owners of the depositors in the bank account, and based on these statements, the owner of the deposit gets a clear idea of how much taxable interest income he has earned on the financial asset, so that the owner's business gets interest payments, which is recorded in his income statement as income.
So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.